If you're anything like me, at one point in your life, you have looked at annual financial statements and wondered to yourself, how can you actually trust these numbers? Well, that's where GARP comes into play. GARP is an acronym that stands for the Generally Acceptable Accounting Principles. At its core, GARP are the agreed upon set of rules that instruct and inform accountants on how to record, present, and measure financial information in such a way that it is reliable, comparable, trustworthy, consistent, and not misleading. In other words, GARP exists so that companies do not just grab figures out of thin air. What GARP basically does now, in simple words, in layman's terms, is simple questions like, how do we value assets? When do we measure revenue? When do we measure expenses? It also instructs us accountants on how to measure things such as depreciation, inventory, and provisions. So that's basically why GARP matters. It protects the users of the AFS, lenders, investors, SARS, management, the independent auditors, maybe even the dependent auditors. I don't know, the internal auditors. I was saying the external auditors, maybe even the independent auditors. Because everyone trusts that the AFS all follow the same set of rules, GARP. If the GARP were to be ignored for some silly reason, the AFS would become completely unreliable, and the decisions that are made in the company about the company's future, now how it will operate as well, these decisions become absolute dog. They become absolute malarkey, bro. So stick around and I will list the 7, yes, there are 7 GARP that we need to know at my level. I don't know about anyone else, like in total, but at my level, there are 7 GARP principles that we need to know, and I'll share those with you guys, and I'll make a series out of it. So tune into my profile and check those out. Let's go.